All right, let's get right into it. Today, we're going to connect some dots that you might not think are connected at all. We're going to trace a line that starts with a huge tech decision over in Beijing, snakes its way through the very tense meeting rooms of the world's central banks, and lands right at the price you might pay for a house here in America. So yeah, let's dive in.
I know, right? It sounds like two completely different worlds, but what you're going to see is how they're tangled up in this incredible web of global economics. We're going to unpack exactly how one big move in the tech industry can send ripples that you literally feel in your own wallet. And our story really kicks off with one single decisive action. And this isn't just some small ripple. Nope, this is the first big, heavy domino tipping over, and it's about to set everything else in motion.
And there it is. That's the headline that kicked off this whole chain reaction. China's main internet regulator has straight up told its biggest tech companies to stop buying Nvidia's latest and greatest AI chips. And let's be clear, this isn't a friendly suggestion. It's a direct order to cut the cord on this specific piece of advanced American tech.
So, who's who in this showdown? Well, this table lays it out pretty clearly. You've got the regulator, the CAC, calling the shots. Then you've got the American company, Nvidia, which just lost a massive market overnight. And then, caught right in the middle, are the customers. We're talking giants like Alibaba and ByteDance, who are now forced to just tear up huge orders. You have to understand, this is a very deliberate move by Beijing. It's all part of their bigger plan to become technologically independent from the United States.
So China makes this really loud, aggressive move. And what's the reaction in the West? Well, it's silence. Just this profound pause. It's like the entire financial world is just holding its breath, waiting for the next signal. And that signal? It's all about interest rates.
You know, central banks like the U.S. Federal Reserve are basically walking a tightrope right now. On one side, you've got softer job numbers and sluggish growth, which are practically screaming for them to cut interest rates to get things moving. But on the other side, inflation just won't go away. It's sticky. And all these geopolitical risks, like the chip ban we just talked about, create a ton of uncertainty. So yeah, they are completely caught between a rock and a hard place.
And this uncertainty, it's not just some abstract idea. It has very real consequences. Just look at Canada, for example. It's a huge economy that's super sensitive to these global jitters. Their record-breaking stock market rally? Halted. Investors, they're all in wait-and-see mode. The government is even delaying its budget. And to top it all off, the prices for key commodities, the very backbone of their economy, are starting to fall. The entire system is just on pause.
Okay, so to really get why the U.S. Federal Reserve is hesitating so much, we have to zoom in on the American consumer. Because honestly, the data they're looking at is sending some seriously mixed signals.
Just get a load of this number, 0.6%. That is how much U.S. retail sales jumped last month. That's more than double what all the smart economists were predicting. Now, on the surface, a number like that makes it look like the economy is just roaring ahead, right? It gives the Fed every reason to keep interest rates high. But it's not quite that simple.
And that leads us to the million-dollar question. If the economy is supposed to be cooling off, who is out there doing all this spending? And the answer, well, it really complicates the whole picture for the Fed. And here it is, the big reveal. Nearly half, 49% of all consumer spending in the U.S. is coming from just the top 10% of earners. So that strong retail number, it's not really a sign of broad economic health. It's a sign of concentrated wealth. And for the Fed, that is a major headache. What do? Do you base your policy on the average number, which looks great, or on the reality for the other 90% of the country?
So the Fed is in a bind, they're stuck. But here's a wild thing about financial markets. Sometimes, just the anticipation of what a central bank might do can be just as powerful as the action itself. And we are already seeing some huge real-world effects because of it.
Check this out. The average U.S. mortgage rate has dropped to 6.39%. That's its lowest point in months. Now, how is this happening when the Fed hasn't even cut rates yet? It's because the market is betting that they're going to cut rates soon. And that expectation, all by itself, is powerful enough to start lowering the cost of borrowing for everyday people. And the result of that? It's been immediate and it's been dramatic. Mortgage applications have just soared by nearly 30%, hitting a 2-year high. And refinancing? That's up by a staggering 58%. The housing market, which was basically frozen solid by high rates, is suddenly showing these powerful signs of life, and it's all based on the hope of a future policy change. But here's the twist. While the U.S. housing market is feeling all this optimism, the global commodities market is telling a totally different story. Gold prices are down, copper is slipping, and part of that is because of weak demand from China.
See how it all connects back to that first domino? And oil prices are losing ground too. It just goes to show how uneven these economic ripples are. Some parts of the economy are feeling relief, while others are really feeling the pressure.
Okay, so we've connected a chip ban in China all the way to mortgage rates in the US. What's the big takeaway here? What are the key forces you really need to understand to make sense of this crazy, uncertain environment?
You know, if we boil this entire situation down, three things become crystal clear. First, geopolitics and technology are now totally intertwined. That US-China rivalry is actively reshaping how everything gets made and sold. Second, the central banks are in the driver's seat. Their decisions on interest rates are the single most important signal for all markets right now. And finally, all of this high-level stuff connects directly back to you. These global policies are what influence everything from your mortgage rate to the stability of your investments.
And so ultimately we're left with this one big question. We've got these incredibly powerful, conflicting forces at play. You've got a tech war pushing the world in one direction, and you've got the hope for lower interest rates pulling it in another. We are at a true economic inflection point. And whichever way this tide finally breaks, well, that's what's going to define the financial world for all of us.